What?
Hello.
Hey, good morning, Anna. How you doing?
Doing well. How about you?
All right. Hey, I've been told that I've gotten a little bit ahead of this class, and I'm not sure what we want to do here. We've got. Have you taken your first test yet, Anna?
We've taken the chapter quizzes, but the first exam that's like chapters 1 through 3, I think is next week or maybe this Saturday or something.
Okay. So you're testing this week over the weekend, roughly in chapters 1, 2, and 3. So why don't we? If it's okay with you, why don't we just go through a review for the exam? Is that okay?
Yeah, that sounds good.
Uh,
Yeah, it says the exam is due the 16th. So
There
next
we
week.
go. Okay, now we have a game plan here, huh? Hold on. Who do you like in the Super Bowl, Anna?
Hang on while I remember who's playing.
I'm just teasing. The Philadelphia Eagles and the Kansas City Chiefs are playing.
There you go. Do you have a preference?
Yeah, my family is all back east in the Pennsylvania, so yeah, I guess I got to root for the Eagles.
You sound excited about it.
Well, I will be come game time.
Fair enough.
All right, let's see. Hold on one second. This thing's giving me trouble. Okay, hold on here. Could I take a quick phone call here? Anna just came in. I need to say hello to somebody.
Yeah, sounds good.
Hiya, Brad.
Hello.
Brad, I'm in the classroom right now.
Okay, buddy, I can't talk to you. Hey, when you get out, give me a call. I want to talk to you.
Yeah, I've been meaning to get back to you. I'll be back. Give me about an hour, okay?
Okay, buddy.
Thank you. Bye-bye. Come on, come on, come on, come on. Okay. We are getting there. Hit that button. Load this into PowerPoint. Okay. Hi, Ali. How you doing?
Good.
You got here at a good time.
I thought I was running late, so I was like, oh, I better log in right away.
Yeah. What we're going to do, we're just going to go through a little test review today, okay? You're testing in a couple of days on chapters 1, 2, and 3. So let's go through those together, okay? If you have any questions or you're finding something troubling in your homework or something, or you want to show me your homework, we can, do that type of thing, okay? My first question, Ali or Hannah, can you see the slides?
Yes.
Yes.
Okay. All right, that's a good start here. Hold on. Still doesn't want to work. Give me one more moment.
Mhm.
Ellie, did you come into tutoring a couple of weeks ago for just a minute?
No, I had come from church and I was trying to do my homework and it accidentally put me into live tutor link.
Oh, okay. Because
Yeah.
I saw your name pop up. Okay, let me share the screen now. Come on. Share. You see it again, Ali?
Yes.
Okay, here we go. I'll take us through the PowerPoints fairly quickly. I don't think this first test is going to be a real buzzsaw. Chapter 3 will be quite important, but let's look at chapter 1 and see what we have here. They talk about the purpose of accounting. Accounting is the language of business. No business can live and exist unless they have good accounting, okay? It provides financial information about the business to external and internal users. Remember we talked about that? Management needs to know what's going on. The employees need to know. And we had this little grid here where owners, they're mostly interested, are we making money? And what's the current financial condition of the company? They may not get mired down in the details, but that this is for decision making. Now, you might be a manager, perhaps a production person, an hourly employee who gets a bonus if they produce more than the quota. They certainly need to know what's going on with the business. So the managers deal with the details, owners, the big picture, okay? What's a creditor? A creditor is a money lender. A creditor represents people to whom we owe money. No one is going to loan you money unless you have decent financial statements, audited and attested. And of course, the government has a group we know is the IRS. They want to know what you're doing tax-wise. So we talk a little bit about the accounting process, system of gathering information and reporting this information to users. Gathering the information. It can be something as simple as the water bill came in the mail today, and you look at it and you think it's a reasonable, correct number, and you record it. And eventually all these transactions are going to wind up in the form of financial statements. The test bank, and that's where these questions are coming from. I'm not selecting the questions kind of at random, but they like to throw some of these terms down. So you look at this screen here a little bit, analyzing, recording. Those are the first couple of steps, huh? You analyze what's taken place, you record, you classify it into the right section of your chart of accounts, and then you summarize and tell the results with financial statements. And then there's a lot of, after the month is over, there might be some meetings and definite deadlines to explain what happened, okay? GAAP, we know what GAAP means, right? Generally accepted accounting principles, and FASB, F-A-S-B, Financial Accounting Standards Board. FASB makes up the GAAP rules. All financial statements that are worth anything are done on a GAAP basis, an accrual basis. GAAP, generally accepted accounting principles. The rules you follow when preparing financial statements, it's the rules you follow every day in recording transactions. And it's the Financial Accounting Standards Board, FASB, who comes up with the rules, okay? And I'm not going to go into any detail here other than to say FASB is always looking at the world. The world changes, technology changes, intellectual property grows, and there may be an issue, an accounting issue, which they'll examine at the FASB meetings, research it, and they may come up with a brand new GAAP rule or a change. And to give you an example, I think you can relate to. You ever go buy a gift card at a store, Target or whatever? You go in there and you spend $100. It used to be, if you did not use that card, as some people do, they tend to lose them or put them in a drawer or something. If you didn't use the card, that was considered full income to the store. Okay, FASB said that's not a good way to go any longer. Now the stores have to estimate to the best of their ability how much of these cards are not going to be used. And that is an example of developing a new GAAP rule. By the way, companies want you to come in with those cards. They don't like it when you don't use those cards. They want you to come in the store, because if you're like me, and I think I speak for the majority of people, if I get $100 gift certificate from my Aunt Mary and I walk into the store, I'm going to spend more than the $100, and the store knows that. Okay. Ownership structures, sole proprietorships, partnerships, and corporations, sole proprietors, one owner. That owner assumes all the risk personally. You remember that? You start a business with $10,000 and somehow you really screwed things up, and at the end of the year, you owe $100,000 and you're out of business. You owe that $100,000 personally. There's no protection. You can't say, well, that's not business money. That's not mine personally. The good thing is the owner reaps all the rewards. If the business succeeds, the owner can make all the decisions, has nobody boss them around. Partnerships share the same kind of risk as a sole proprietorship. They assume personal risk for losses, and they can be, you have their home taken away from them. But you might find it interesting that a lot of service intellectual businesses, I'm talking about law firms and architects, and especially accounting firms, they seem to be almost always partnerships, as opposed to incorporating. And I think that is the reason for that is they're showing the world that they're not afraid of getting in trouble, that we know what we're doing. Partners may disagree on how to run the business, and when that happens, you can have all kinds of problems. I like the television show Law and Order. You ever see that show, anybody? Anyway, half the murders on that show is a partner shooting the other guy. They start the show, they find a dead body, they open up his wallet. Oh, he's a partner in a law firm. Anyhow, partnerships can be tricky. Corporation owned by the shareholders, the stockholders. Limited risk. You buy 100 shares of Coca-Cola stock or Microsoft or IBM, and you hold that, and hopefully the stock goes up. But if the company went out of business, you have no personal loss other than your original investment. And of course, stockholders have very little influence on the business. 100 shares of Coca-Cola, that's like a grain of sand on the beach here. And then businesses by activity: service business, merchandising, manufacturing. Service business is a lot of ACC 110, what we're doing in this course. When we get to 230, we'll do a lot of merchandising. A merchandiser buys and sells a product. Service business just does that, provides a service. And then you got manufacturing, which is accounting 240, okay? And then I'm not going to go through these career opportunities, accounting clerks book. I have no reason to think that this stuff would be on the test at all, okay? So we'll get out of chapter uno here in a second. Stop sharing. Okay, any questions or anything, Ali, on that, or Anna?
No,
Yeah, it's pretty basic, right?
yes.
Okay,
Is
now,
there any distinction when defining a corporation if it's publicly traded or not, or is it just basically
Say-
anything?
say that again, please.
Is there any distinction for the definition of corporation if the stock is publicly traded or not, or is it all
Well,
just kind of the same
uh,
category?
A corporation can be publicly held, meaning they issued stock to the public and the public trades that stock every day. Or it could be privately held, where there are no stock issues to anybody, just management owns the company. So yeah, you can have the two different forms. That
Okay.
answer your question?
Yeah, thank you.
Yeah. Okay, give me a moment here. Dig up chapter 2. Come on. Chapter 2. Can you see the screen, Ali?
Yes.
Okay, here we go. In Monday's class, I was babbling for like 20 minutes before somebody pointed out there were no slides up there. I forgot to share. I had to start all over again. Okay, analyzing transaction. Here, chapter 2 was we introduced the accounting equation: assets equal liabilities plus equity. What is a business entity? Is anybody involved in the activity of trying to make money, controlling economic resources? And we have to understand that the boss's personal business money cannot be mixed up with the companies. And that's what we call a drawing. And we'll go over that one more time. Okay. The owner of a business may have business assets and liabilities, but the non-business assets are not included in the business entity's accounting records. Once we get through this first test, you're not going to see the words drawing anymore. But they do want us to go over it because there are a lot of small businesses and you have to know what to do. Okay. If the owner invests money in the business, that investment is now a business asset. What is an asset? An asset is a good thing to own. An asset, anything owned by the business that will hopefully help generate future benefits. Must be owned. You can't rent an asset, but you don't have to have it paid off. You could buy a fleet of cars for your company, and you're going to pay those cars off over the next 5 years, but you own those assets. And we're talking, our favorite asset is cash, then accounts receivable, merchandise. That's your inventory you buy and sell. And you can have big ticket items like machinery and equipment. Let's understand what accounts receivable is. It's the amount of money customers owe you at any point in time. Accounts receivable. You're my customers. You do. I have 2 customers. And Anna owes me $50,000. Ali owes me $150,000. That means that my accounts receivable are $200,000. And the fact that I'm counting on you to pay me, which is reasonable, that's why we call it an asset, okay? Promise to pay. A liability, that is a debt. That's an IOU. Something owed to another business entity, and we're talking accounts payable. Accounts payable. It's the reciprocal or the opposite of accounts receivable. So when I used my example before, my accounts receivable, if you recall, was $200,000. You guys are on the other end of this example, and Ali's accounts payable is 150 and Anna's was 50, if I remember the numbers correctly. Okay, accounts receivable and accounts payable, it's the same thing depending what side of the transaction you are. If you are the one expecting to get paid, it's accounts receivable to you. To your business partner, it's a liability called accounts payable. Accounts payable, it's an unwritten promise. There's no contract involved. There may be a purchase order that describes what you want to buy, what you're going to pay for it, when it's going to be delivered, but there's no formal contract like in a note. Okay, these kinds of purchases are said to be on account. When you see the words on account, add the words to yourself, on account of no money. On account of nobody had money. On account means you're selling something to somebody and you're willing to wait to get paid. And that's how the whole economy works. And be careful, don't confuse receivables and payable. Ask yourself, what side of the fence are you? Are you waiting to pay somebody or waiting to receive? Okay. Note payable, go over this a little bit, huh? Note payable is a borrowing situation. Here, you do have a formal written contract. That contract will say how much money is being borrowed, what the interest rates are, what the terms of repayment might be. If a company went out of business, people who own a note payable will get paid before any money can go to the accounts payable. Notes payable is what's called a secured loan. You have a little more comfort that you'll get paid. Owner's equity, also called the net worth, the capital, stockholders' equity, huh? It's the value of the company on paper. It's the amount left over after you subtract the liabilities from the assets, okay? Assets. Say hello to the accounting equation, right? Assets equal liabilities plus owner's equity. If you had $1 million in assets and 400,000 in debt liabilities, your business on paper is worth 600,000. Okay. Assets equal liabilities plus equity. So in this little example here, business has assets of 60,400, liabilities of 5,400. What would the equity be? It's simply 60,400 minus the 5,400 gives you the 55,000, okay? This thing is stuck for a second. Just give me a moment. We started off with some business transactions. And I'm not going to go through this in any real detail because it's more important to understand it in terms of chapter 3. This is before you learned about debits and credits, huh? What's a business transaction? Any economic event that impacts the business. And it's normally with an outside entity like a sell, like someone who sells to us, someone who buys from us, the electric company, utilities, insurance companies. And all of the business transactions affect the accounting equation through specific accounts, huh? An account, the chart of accounts is in the inside cover of your book, I believe. That's the list of the items we track, like a folder, if you will, in our general ledger. Accounts, cash, accounts receivable, electric expense, things like that. So a transaction occurs, 3 questions on what happened. Make sure you understand what has just happened. It could be something as simple as opening up the mail and there's a bill from one of our suppliers. That needs to be recorded. That's a transaction. It might be the end of the payroll period, and you've got a complicated payroll to code into different categories and get that done. That's a transaction, okay? All transactions impact the accounting equation one way or the other. And we started to go through this. Mitch Williams invested $5,000, and what happened when he invested $5,000? Cash went up and the equity went up. And they presented it to you in the form of this horizontal grid, okay? They're showing you the accounting equation. And then they had another transaction. They bought an asset for cash, and we bought an asset for cash. Well, the one asset goes up, delivery equipment, and the other asset goes down, okay? So what I'd like to do is get out of chapter 2 and get into chapter 3, where we talk, I believe, the debits and credits, okay? Just a few more terms here. Revenues. Revenues are your sales. It's what you charge your customers for your products. Revenues always increase equity. Expenses decrease equity. Expenses are the things you need to pay in order to stay in business, right? Rent, salaries, supplies, etc. The accounting period concept, it's just a gap definition that any business can be analyzed in terms of 1 month if you want, 3 months or a quarter or a year. And any accounting period of 12 months is called a fiscal year. And the fiscal year may not be the same as the calendar year. Some companies, their fiscal year might begin July 1st or November 1st or for some oddball reason, dealing with the type of product they deal. Net income, huh? That's the good one. Revenues are higher than expenses. When revenues are less than expenses, we lose money. And here, let's talk about the withdrawals just a little bit, because this will be on the exam, probably in a multiple choice question too. The owner comes out and says to Anna, who's got charge of the checkbook, Anna, cut me a check for $1,000 right now, would you please? And you say, sure, boss, what's it for? You need to know what it's for. And the boss says, I'm taking my wife to Las Vegas over the weekend. Well, at that point, you know, it's not a business transaction. It's the personal business of the owner. So you would credit the cash, you would decrease the cash, but you would reduce the equity in the company through the withdrawal account, okay? A withdrawal by the owner is not an expense. It's a reduction of the company's equity. And they're showing you the expanded accounting equation here. Look at owner's equity. What affects owner's equity? Capital, money you put into the business, minus any money you pull out of the business, plus your sales revenues, minus expenses, okay? And then we went through more transactions, and we did most of these transactions again in chapter 3. So, wow, we did a lot of work, huh? Prepare and describe a simple income statement, statement of equity, and balance sheet. Please remember that you have to do the financial statements in this order. You have to start with income statement, then do the statement of equity, and then the balance sheet. The income statement, statement of equity, and balance sheet. Those are the 3 major financial statements. These are the things investors are going to start pouring through these statements and try to understand how you're doing. And let's take a quick look at a simple income statement. Delivery fees for this company was $8,000. You list the expenses, itemize the expenses, subtract the expenses from the revenue. And wow, this guy made $5,250 on sales of $8,000. That is great. It's like almost 70%, huh? Statement of owner's equity. This is the statement where you have to layer the net income into the equity. This is the statement that gives students trouble, although it's quite easy if you just think about it a little bit. It's put together as follows. It's your beginning balance in the equity, which in this case is 5,000. I'm starting with the original investment at the beginning. Beginning was 5,000. We know we add the income to that because income increases the equity. Offsetting that is a reduction for the withdrawal, and you have a new equity number of 7,250, which you then bring over to your balance sheet. The balance sheet is a representation, if you will, of the accounting equation. It shows the assets listed on one side and the liabilities and equity listed and totaled up on the other side. Assets equals liability plus equity. This is the last slide in this chapter. And the reason I bring it to your attention, this question has popped up on the test a few times over the pandemic online courses. What's the accounting process? You input, process, and output. IPO, if you kind of remember that one, okay? Not a deal breaker, but that one's popped up on the test, and I don't know why. Okay, I stopped sharing. You okay, Ali?
Yes.
You okay, Anna? Want me to keep going?
Yeah, all good.
All right.
Is the test open book or closed book? I know it's timed, but
It's well, you know, we have to put you on your honor system. No, it's not supposed to be open book.
okay.
But the worst, I'll tell you this, guys, the worst thing you can do is say, okay, nobody's watching me. I'm gonna use the book to look up the answers. By the time you look up the answers, you're gonna run out of time.
Yeah, that's why I
So-
was asking, because oftentimes if it's timed, it's because they allow you to use the resources because you won't have time. But if that's
That-
not the case, that's fine.
Right. You can, if you want to use the book, no one's gonna know otherwise, but it's not the way to go. It's not the way to go, because the test can be a bit onerous. I don't know, what's it gonna be, 40 questions and 40, 60 questions in an hour or something? It's a little bit lengthy, huh? Okay, let me. All right, chapter 3. Now, this is the one where we really want to put on our thinking cap, okay? Right, over here. Do you see the slide, Ali?
Yes.
Yes, okay. That was a yes. Okay, here we go. Chapter 3. Now we're going to talk about debits and credits. And this is where it gets a little tricky. If you exit this course being very comfortable with your debits and credits, that's going to serve you well when you go into 230. Believe me. So let's talk about that. The double entry framework. Every transaction, as you know, involves 2 accounts, huh? You have to have 2 accounts in any transaction. 2 at a minimum. And we're going to talk about the T account. The T account is simply a poor man's general ledger, just to start to get you familiar with what your general ledger looks like. You're going to have a T account, And you're going to see the left side is debits. The right side means credit. That's all debit and credit means. Debits on the left, credits on the right. So let's understand that. Don't be like a guy. I tell this stupid joke every semester about a guy who worked in accounting for 50 years. And every day he came to work and he unlocked his drawer and he picked up a piece of paper about this big and he looked at it. He studied it for about 10 seconds, put it back. After he retired, they were curious to see what it said on that piece of paper. You know what it said? Debits on the left, credits on the right. Now, hopefully it doesn't take you 50 years to understand debits and credits, okay? Debits and credits, left and right, that's all it is. DRCR. You're gonna have one T account for every item in your chart of accounts. Cash. So we're no longer going to say we're increasing the number or we're decreasing. We're going to talk in terms of debits and credits. And this is a tricky part of the class. Every T account has an increase side and a decrease side. Some accounts increase on the debit side, some increase on the credit side. And we just have to memorize those rules. And it's really just 5 things to remember, but it can still make you hesitate and have a little agita. Let's look at the T account in action. All right, here's cash, huh? Cash had an entry on the debit side for $2,500. And on the other side, it had a lot of expenditures. So the debit side added up to $3,500. The credit side added up to $3,130. The high man wins. $3,500 minus $3,130 gives you the balance at the end of the month of $370. So I think we're pretty comfortable with how to come up with the balance. You add each column and the difference becomes the balance, okay? Describe the effects of debits and credits on specific types of accounts. It's a debit account. Means we're putting the number on the left side, to credit goes on the right side. They could be increases or decreases depending on what we are dealing with. So let's look at assets, huh? Assets, they have what's called a normal debit balance. See that plus sign there? Assets are increased with a debit. When we say the normal balance of an asset is a debit. So when we receive money, we put it on the debit side. And when we spend money, which reduces our cash, of course, we put it on the credit side. So that's the first thing you have to remember. Assets, debit balance, okay? We'll go to part 2. Liabilities. Look at this now. Liabilities are increased on the credit side. Sounds crazy, huh? That's the rule. Liabilities like accounts payable, notes payable, any kind of payable goes up with a credit, okay? Just have to memorize that. Assets debit, liabilities credit. Equity also goes up with a credit. Again, you just have to memorize 3 things now, right? Asset, debit balance, liabilities and equity credit. Assets equal liabilities plus equity. Assets have a normal debit balance, which means the debit side increases. That means that liabilities and equity have to have a credit balance, okay? Revenues or sales, credit balance. When you increase a revenue, you're doing it on the right side, on the credit side, okay? And finally, expenses. Expenses go up with a debit. Now, it's easy for me to sit here and say, oh, it's only 5 rules. That's easy to remember. No, it's a little tricky. You have to do your homework. You have to kind of look at it a little bit. But But once you master the rules of debits and credits, meaning what increases what, you'll be in good shape. The withdrawals or drawing, that go up with a debit, but let's not worry about that one. It goes up with a debit because it reduces your equity. Withdrawals or drawing is a part of your equity, okay? And here they're giving you one picture that might help memorize. Assets, remember debit, liabilities go up with a credit. Owner's equity goes up with a credit. Owner's equity consists of your capital, any money the guy put into the business, plus revenues, which increase on the credit side, minus expenses, which increase on the debit side, and then minus the drawing. This here, I think, is the best grid right here. You don't have to go any further than increase. Assets increase with the debit, liabilities credit, capital credit, revenue credit, expenses a debit, drawing a debit. Once you have the increase in your brain, takes care of the rest, okay? So that I think is a good grid to maybe print out and look at once in a while when you're watching television. During a commercial, just glance at it. Now we're going to use the T accounts to analyze transactions. Remember this guy opened up a business for $5,000? Cash goes up, right? He put cash into the business and his equity went up. But we're not talking up, down anymore. We're talking debit and credit. You debit cash, and you credit capital. You see, we've got the T accounts going now, unlike in chapter 2, where everything was just spread horizontally across the page. Bought an asset for cash. He bought an asset for cash. Well, his cash is going down, but he bought delivery equipment. So that's going up. Delivery equipment went up by 2,000 and cash went down by 2,000. In other words, the assets stayed the same. It was just a switch in assets. At that point, he would rather have the delivery equipment than the too large, okay? He bought something on account. On account, nobody had money. That's what on account means. So you know it's going to be either accounts payable or accounts receivable. We're buying the motor scooter. We are going to have to pay for it in the future. That makes it accounts payable. And accounts payable is increased with a credit. And we have more delivery equipment, $1,800, okay? Payment on account. Now he's paying for some of that. He just financed $1,800 with a vendor. Now he's going to pay part of it. So your cash is going to go down with a credit, and your accounts payable goes down with a debit. Accounts payable, you debit it, which has the effect of reducing the balance, and you credit cash, which reduces the cash balance. He did some deliveries for cash. Well, now he has revenues. So revenues have a normal credit balance, hopefully we know, and cash has a normal debit balance. So cash went up with a debit and revenue went up with a credit. There's the 2,100 there, cash. So you see how we're layering these in on the debit and credit side? Eventually we come to the balance, okay? Paid the rent for the month. Paid the rent. That's an expense. What kind of expense? Rent expense. Rent expense we debit, cash we credit. Paid the phone bill. That's another expense. We debit phone expense, we credit cash, okay? Delivery revenues earned on account. Again, on account of nobody had money. So you know it's either accounts receivable or accounts payable. Mitch made deliveries on account for 2,400. Well, his cash doesn't go up yet. What does go up is the accounts receivable, money he's going to get paid later. And here we go. We just added in another account called accounts receivable, and we're showing the revenue side over here with a credit, debits and credits. He bought supplies. Whenever you purchase supplies or an insurance policy, they're considered assets at the point of purchase. It's only when you start getting the benefit of those purchases, they become an expense. So here we bought supplies. One asset, cash, goes down. With another asset, supplies went up. Okay. Cash receipts. He received money from a customer. You see that 2,400 now in accounts payable? Now 1,900 of it came in the mail today. He received the cash. That doesn't affect revenue. We already recorded the revenue at the time of the sale, right? Which is proper GAAP accounting. So here, his cash asset goes up with a debit, and accounts receivable come down with a credit, debits and credits. Here, he bought something on credit, on account, but he made a partial payment, huh? He had to make a down payment. So here we have a three-line entry, huh? What happened? He bought equipment. We're going to debit the equipment for the full 1,000. We're crediting cash because cash goes down with credit, and we're increasing accounts payable. He owes that money now. Okay. And here they're showing it here. Boy, this guy buys a lot. Where's the 1,900? Oh, there it is. I'm just having trouble reading it. I can't see it. My eyes are shut. There's the 700 there in the accounts payable going up. Don't confuse payables and receivables. Cash goes down, and he had an asset. Accounts receivable goes down. Okay. Hey, he bought an insurance policy. He bought an insurance policy. You debit the asset, prepaid insurance, and you credit cash. Okay. You see these assets are starting to layer themselves out now. Paid wages, salaries expense. We're gonna record the salaries expense with a debit, because we now know expenses have a normal debit balance, and we're going to credit the cash. Here he made deliveries for cash and credit, okay? So we know that he has revenue, and it looks like the revenue was $3,500, $2,600 on account, nobody had money, meaning that 900 was received in cash, right? So take a look at it. We're going to credit delivery fees for $3,500. That's money he's earned, whether or not he's paid yet. Our customer is going to pay us $2,600, hopefully next month. And in the meantime, some of our customers paid in cash. Okay. And then the withdrawal. The boss comes out and says they want $3,000, and he asks them why, and the boss says, "That's my salary. I'm paying myself." That is a non-business transaction. That's just personal stuff. Okay. And what do? We debit the drawing and credit the cash. Okay. Now we've put all this information together. We have all these balances sitting here now. The month comes to an end. It's time to prepare financial statements, huh? Before we can do a financial statement, though, it behooves us to prepare what's called the trial balance. trial balance. All it is a listing. All it is a listing of all the accounts, and it goes in the order of assets, liabilities, equity, revenues, and expenses, okay? All it is, you list the debit balances, in the next column, the credit balances, and when you add them up, they should be the same, right? They should be the same. And here is a trial balance, okay? Let's take a look at it. Cash, remember we ended up with $470 in cash, and we had 3,100, okay? The only thing the trial balance does for us is prove that the debits equal the credits, okay? Going forward, if any of you go out into the business world, you are not going to have to worry about a trial balance going out of balance, because I can't believe any modern bookkeeping system or accounting software would allow you to put in an out of balance number. Now, back in the old days, I'm talking about like 19, it was a long time ago. I got out of school in 1971, so you know what I'm talking about. Back then, all this stuff, believe it or not, was done in pencil. And believe it or not, you could make mistakes, and you'd run the trial balance and it wouldn't balance. Oh, what a fiasco then. You had to do whatever was necessary to get that thing back in gear. Here they're showing the links between the trial balance and the statements. This is a very good grid to look at, okay? Because going forward, here is where we're going to prepare the financial statements. The only thing the trial balance tells us is whether the debits equal credits. But once we've done that, we can now use the trial balance to start fleshing out the financial statements. You see where it says delivery fees? Go to your first revenue line. It's just a recommendation, and draw a horizontal line. The reason you want to draw that horizontal line on top of the first revenue item is because everything below that goes on your income statement. Everything above it goes on the balance sheet. Save a little bit of confusion, huh? So here, they're taking that trial balance, and look at your income statement. It's right here. $8,000 in sales fees, and then they had 3 expenses. So take a peek at your income statement. Income statement is simply sales minus expenses, huh? This business had $8,000 in sales or revenues. The expenses totaled $2,750, meaning they had an income of $5,250. A very lucrative business for a summer job, huh? My goodness. We have to do the income statement first, because we then take the net income and we add it to the beginning balance of 5,000 and subtract the withdrawals of 3 to get the new capital number. Once we have the new capital number, you see how it flows from the equity statement into the balance sheet. And there we go. Those are our 3 financial statements. And that brings us to the end of the slide. Any comments, any questions, anything you want to look at, or? You good, Anna?
Yeah, I think so.
Okay. Are you pretty good with the debits and credits?
I think so, but I haven't taken the chapter 3 quiz yet, so we'll see.
You're okay, Ali?
Yeah, it's pretty self-explanatory so far.
Yeah. Let's master this chapter 3, and then going forward, we'll do some real type accounting, okay?
Okay.
All right. Well, you take care, everybody. Enjoy the Super Bowl, and we'll see you
Thank
next
you.
Wednesday, okay?
You too. Bye.
Bye.
Bye-bye.